This is the video for Monday, October 30th for all sections. We're going to go through the Home Depot solution for homework 9 during this class and set you up to do homework 10 for next week. But before we get into the homework 9 solution, I want to talk about the Bloomberg Trading Challenge. It started over a week ago, and when I was looking at where teams stand, which I was going to show you today, I noticed that several teams haven't even started the trading challenge. So I want to be really clear. The Bloomberg Trading Challenge second half has started. We are now 1 week in with 5 weeks to go. If your team is not in compliance with the rules by end of day October 30th, then your team will be disqualified from the trading competition. All members of your team will receive zeros for the second half of the project. None of the members of those teams will be able to opt out of the final exam. So checking in on the Bloomberg Trading Challenge. In section 101, the good news is 4 of the 5 teams are paying attention to the instructions and the requirements of the class. One team is above $300,000 worth of cash. They have until the end of day tomorrow to trade something and get below $300,000 worth of available cash, or they will be disqualified. We also have one team in the section who has not started yet. If I look here at Managed Network, looks like the team with Gregory Rosario. You are the team who has not traded yet. That is not acceptable. The deadline for trading was a week ago. Again, if you have not started trading and traded all stocks and being less than $300,000 of cash by end of day October 30th, your team will be disqualified from the competition. There will be no makeups for non-completion of a group assignment. Again, you need 10 longs second half of the semester. You can buy the same stocks as you did the first half of the semester, but you have to trade equities. And the trading competition is now 1 week in. There are 5 more weeks to go. Okay, you need to be 10 longs by the end of those 5 more weeks, but you can never be more than $300,000 worth of cash at any point as of last Monday in this trading competition. I'm giving one more grace period to this, but no more extensions on this. For the team in section 201, you are faring far worse because 2 of you are going to be disqualified for having too much cash. The other teams haven't even started the competition yet. So again, you have until the end of day on October 30th to start the trading competition. In section 301, it appears that one team did not pay attention to the available cash requirement, and if they don't trade by the end of the day below $300,000, then they will be disqualified. There also appears to be one team in this section that has not started the competition yet. Again, you have until the end of the 6-week period to make the 10 longs, but the available cash requirement is one that must be enforced as of end of day October 30th. And finally, for section 401, same thing. We see that one team is not paying attention to the available cash requirements, A or T's. You need to buy something by end of day October 30th, and we see 3 other teams have not started or bought anything in the first week requirement for the trading competition. So again, I don't know how I can be more clear on what the deadlines are, but I'm not giving any more extensions past end of day October 30th. So if you choose not to participate in a team project, you're not going to get credit for a team project. Simple as that. All right. So what I really want to focus today on is the Home Depot valuation, which you had done as part of homework 9. So let's go back to Excel. And you should have started with your NVIDIA valuation model that we completed in class last week. Okay? And the next thing that you should have done is you should have exported from Bloomberg the requirements for the income statement, balance sheet, cash flow, model data tab. So that's this file. Okay? So as you're doing your evaluation to reuse the model, you take the data that you had exported from Bloomberg, in this case for Home Depot. You would then copy that data. You go into what used to be your NVIDIA model. You select that first tab of model data, right click, paste special values, and that would overwrite all of the data for NVIDIA with Home Depot. And again, if you had done that row for row, cell for cell, then the model should be working. One way to always check this is to go to your CFI and make sure that your CFI still balances. Okay, that's a clue that if it doesn't balance, that you have a problem in the data that you are bringing in. So with that in mind, we'll then continue on with our Home Depot valuation for this week. So the next thing we want to do is check the latest fiscal year that has been completed, which for Home Depot is actually 2023. Okay, so essentially they had a fiscal year which ends on January 29, 2023, so they're technically in fiscal 24. So we make sure here on the Assumptions tab that the last reported year is indeed 2023, similar to NVIDIA. Okay. Now remember that as we are setting up this valuation model, the data in here is actually the NVIDIA data, not the Home Depot data. So the next important thing that I want to do, since I'm going to be valuing Home Depot, is switch this name of the file to Home Depot, and this is going to be for section 101. So I will save that file, and now I'm going to continue on with my Home Depot as is valuation. So as a matter of fact, what I need to do is rename this the Home Depot instead of 101, should have called it the as is. Okay, so this is going to be the first of 4 Excel models. Now this is the one that was required for your homework assignment, but I'm going to talk to you about the other 3 as part of the solution here, which will set you up for your next week's homework assignment. So next we have to update additional data for Home Depot. Looking here on the Assumptions tab, we will need their WACC. So again, if I go back to Bloomberg, HD, US Equity, WACC, and I need to enter their WACC, which today is 9.9%. Again, since you're going to be taking screenshots of this, take screenshot, save, and I will call this my HD WACC because I'm going to be turning in my screenshots to my valuation, so I need to make sure I take those along the way. So today, current WACC is 9.9%. Remember, that was NVIDIA's WACC that was in this model. We're now updating it with Home Depot's WACC. Next, I need to update the share count, and I need to update the target share price that I'm going towards. So again, if I go back to the DES screenshot, go to DES, take my screenshot, HD DES, so I have it. 2 numbers I'm going to get off of this screen. This is my DES screen. Number 1, share price today, 276.46. That's what my as-is valuation is going to be, 276.46. And I need to be within $1 of that share price. In terms of the Home Depot share count, right here, 1 billion.1 million. So 1,000.1. Okay. Next, I need to update the consensus revenue and consensus EBITDA for Home Depot. That will come off of screen number 3, which is the EEO screen. So I am on the EEO screen. I need to make sure that I do annual data, not quarterly data, and I start typing in my revenue, 153.471 billion. $157.146. 157.146. For 2026, 161.473. 2027 revenue forecast, 168,346. And for 2028 revenue forecast, I need to go one column over. And that's going to be 174,438. Next, I put in my EBITDAs, starting with 2024, first forward year. EBITDA is 24,758. $2025 EBITDA forecast is 25,576. '26 EBITDA forecast is 26,646. 27 EBITDA forecast is 28,034. And 2028 EBITDA forecast, gotta go one more column over, is 29,252. And then I need, off of the EEO, the consensus EV to revenue and EV to EBIT multiples for the 2 forward years. So forward year 2, forward year 3, here's EV to revenue. Forward year 2 is 2.06 and 2.0. 2.06 and 2.0. 2.00. Actually, I'll put 2 more decimal places just so I know that that is a 2.0. And EV to revenue in the second and third forward year is 14.24 and 13.74. 14.24, 13.74. So that suggests a perpetuity EBIT margin of 14.5 to 14.6. So pretty close between the 2 forward year multiples. And again, this is the EBIT margin versus the EBITDA margin, depreciation, amortization, the difference between the two. Next, I'm going to go to my ratios. And I need to remember that these ratios include some data from NVIDIA. So for example, the out-year EBITDA, which we had hard-coded in our as-is for NVIDIA, 63%. Clearly not the EBITDA margin for Home Depot. And the tax rate was NVIDIA's tax rate. So we are going to also need to get tax rate for Home Depot. So I suggested that we can either go to guidance or BRC. We'll start with guidance to see if there is a tax rate guidance. And there is. They had guided to 24.5%. So we are going to use 24.5% as the tax rate, which will carry forward into the out years. Okay. Now, for this is my operating income, also known as my EBIT margin. And again, this out year number, which is not 61.4%, clearly it doesn't look anything like the last 5 years, should probably be somewhere around 14.5, 14.6. So again, I can't make this 14.5 or 14.6 directly, so we've changed the EBITDA to make this 14.6 or 14.5. So let's assume that I'm going to make it one of those two numbers. So if I'm going to make this 14.6, then this is going to have to be 16.5. Should get me down to 14.6. And if I want to make it 14.5, I'll make this 16.4. Now I'm going to check my share price, and now my model share price obviously is negative. Current share price 276 because we're going to have to solve for the G. Right? So I have my revenue forecasts Now, these revenue growth rates are automatically calculated, if you remember, for those first 5 years based on putting in this consensus revenue. Okay? And these EBITDA margins were adjusted for these 5 years, again, based on the consensus estimates, and we forecasted a perpetuity EBIT margin here, which we then backed into an EBITDA margin for perpetuity. Okay? And then we'd also updated the tax rate. Now we're going to look at the balance sheet, and here we see the ratio of invested capital to sales, which is around 33%. Since we're not changing any of the operating ratios of revenue to the balance sheet item, then essentially we're going to leave all of these the same, because that gives us a pretty consistent level of productivity with where they are this year. So again, the balance sheet is going to automatically grow, and therefore forecast a gross investment for us at a similar level of productivity. And we don't assume Home Depot's productivity is probably going to change all that much in terms of the structure of their business going forward. So these balance sheet ratios seem reasonable. So our last kind of key insight here is to come back and solve for a G. Now clearly your G can't be higher than your WACC. That's why we're getting a crazy number here. And so what we have to do is we have to solve for a G to get within $1 of the share price, given all of these assumptions. So the simplest way to do that, again, I'll just kind of reset this around 3%. And I'm doing this because of Excel. Remember that what Excel is going to do when it uses goal seek is it's going to start with your number, and it's going to kind of iterate a bunch of times until it finds a solution. Somebody had showed me with their NVIDIA model, because they had a weird starting G, that was actually creating a solution that was actually not the correct solution, because it can find multiple solutions that equal the amount. Sometimes Excel doesn't know that it's the wrong solution, and will just stop and say, hey, I found a solution. In this case, that gave that student a gigantic negative G that wouldn't make any sense, that actually solved for NVIDIA's share price. So I'm just going to reset to 3% just as a starting point, and then I'm going to solve for my G. So using the solver, I am going to go to Tools, Goal Seek, and the whole idea here is I want to set cell current share price in the model, which is DCF valuation D31, to equal the current share price of 276.46 by iterating through a G that will make that the case, which is my B7, and solve for that G, which is going to be around 6%. So at about a 6% G, given all these other assumptions, that gets me to the 276.46 share price for Home Depot. Okay, so again, I'm within $1 of my current share price, and this is my as-is valuation. Okay, so hopefully your models should look fairly similar to this. Shrink this a little bit, because depending on when you did this, and I'm doing this on Sunday, October 29th, which means I'm using end of day Friday data. Basically, you shouldn't have seen dramatic changes in Home Depot's in the last week. So your share price G should be similar to this, okay? Plus or minus a little bit, but that's basically the process that we have done for the as-is valuation. Okay? And again, remember, the whole point of the as-is valuation is that we're coming up with a DCF model that models out the current share price using reasonable assumptions. So somewhere around here would be what anybody else's valuation of Home Depot on the street would be, that models out the current share price. Now, from here, we'll save this as our as-is. We are going to create 3 more Excel files for all valuations going forward. The next 2 files are going to be called the bull and the bear, and the final file, number 4, is going to be called the target. Okay, and so here's the idea. The target share price is just that. What do I think the company is going to be trading for in the next 12 months? If I were to go back to Home Depot and I were to go to the ANRs, the analysts, sell-side analysts are doing similar things to what we are. These are their target share prices, right? You'll notice that there is not unanimity of the share prices, because we're dealing with the future and people can have different assumptions. Okay, but as of October 26th, for example, KeyBank didn't put in a target share price, but Truist did. They put in on the 25th 341, Barclays put in 333, Piper Sandler put in 302, etc. So the target share price is your chance to put in your opinion, just as these analysts are doing, about where the company is going to end up in the next 12 months. Okay, the as is explaining the valuation of today. That's not your opinion. Okay, so that's the big difference between the as is and the target. The as is what we think the company should be worth. The target is what it's actually trading at today. Okay, and so before we get to our target, we're going to do two additional files, and that's what we're going to call the bull and the bear. So the idea is, think about this: if I'm a portfolio manager at BlackRock or some other fund and I'm actively trading, then I am creating a diversified portfolio. Well, to create a diversified portfolio, then I need to know what kind of standard deviations I'm going to see on the stocks that I'm putting into my diversified portfolio to make it more diversified. So that's the point. Like, I need to know the upside and downsides for the stocks. I don't just need to know the targets. I need to know the level of risk that I'm taking, my volatility. And that's the idea of the bull and the bear. So the idea of the bull and the bear is to say, okay, how high can a stock go if everything kind of goes well in the next 12 months? And how low can the stock go if everything goes poorly in the next 12 months? That's the bear. Okay? And what it creates is a range, okay, from high to low of where the stock could potentially trade. So that's the idea. In addition to setting a target, analysts also give them a high and a low. Okay? And that's very important for understanding the risk profile of a stock. And so the whole idea of a target is, where along the range do you think that the company is going to actually trade? But that range needs to be bounded by your bull and your bear. So, for example, it wouldn't make sense to have a target price higher than your bull price, right? Because the bull is the top of the range, the bear is the bottom of the range. And so what we're going to do is we're going to create Excel models that explain each of those. And when I say do a write-up of minimum 500 words on your next assignment, what you have to do is talk about all of the assumptions, the key assumptions that you put into each of the models, why you put in those assumptions, and why you're changing those, okay, including with your as is. Now, let's go back and talk about what were the key assumptions that we're going to be talking about. In the as is, the big ones here are on light gray. What revenue growth rate are we using? What EBITDA margin are we using? What tax rate are we using? Now, that's pretty easy when we're doing the as is, because we're kind of using either company guidance, for example, for tax rate, or JP Morgan report for tax rate. EBITDA and revenue growth rate, we're using consensus for the first 5 years. Here we're using the trading multiple for the year 6 EBITDA. Here I'm leaving my growth rate for 29 equal to 28 for revenue growth, because Home Depot seems to be growing about 3% a year, so 3.6% seemed reasonable in the out years. And then the assumptions for the G in my as is, I've solved for the G that basically gets the share price to match using the solver. And I've decided to leave the balance sheet ratios alone because the productivity of about 33% seemed reasonable in the future of Home Depot of IC to sales. So again, I'm saying this when I'm writing up my explanation for my as is. Okay. So now let's talk about the bull and the bear. So back to the bull. So there's where I need to do my homework. Ideally, we would have done an EIC analysis on Home Depot, because that would help us get a better understanding of what some of the drivers of their business are. At a minimum, if you don't do a full EIC, start out with a BICO. See what the important items are for the company that you are doing the evaluation with. And so right now, Home Depot, you can see they say in the BICO here is being summarized by what's happening with the consumer. Mortgage rates are above 8%, right? The housing market is really struggling with high interest rates, which means Home Depot, which sells to builders, a lot of home improvement products, those projects are probably being deferred. Home Depot's also suffering with continued impacts in the supply chain of inflation. And those are going to be two key drivers going forward, which is how much does the challenges that the housing market is having on a go forward continue to affect Home Depot. Now, what the analysts are saying in the BICO today is they think that the next year or two could be tough, but beyond that, they actually think Home Depot has an overall solid future. Okay, so that kind of plays into a more of a bull scenario. Obviously, we can look at the industry outlook here. We can do the IBIS World Report. There's lots of things that we can continue to look at, but we'll only start with those basic premises. So what we're going to do is, with a bull scenario, I'm going to go back to my as is file, and then I'm going to file, save as, and create Excel file number 2, and I'm going to call this my bull. All right, so what is my bull scenario for Home Depot? Well, again, following on what the analysts are saying, that the current downturn in the builders market for housing doesn't take too long, and Home Depot does tend to respond better long term, and that interest rates go down and margins actually stay a little bit better on the cost side. So how do I translate that into my model? I don't think the tax rate's going to change anytime soon, regardless of who wins, Democrats or Republicans in the future. So I think the tax rate is probably going to be in this range, even in a bull scenario. What I think is really going to change for Home Depot, though, is 2 things. One, you'll notice that the margins in the last couple of years during a building boom for Home Depot, especially during COVID when a lot of people were renovating, actually spiked up to 17%. And so they're trending down in perpetuity to 16%. So one of the things I'm going to say in my bull scenario is, what if they got back to a 17% EBITDA margin in perpetuity? And part of the idea is, in the long term, Home Depot maintaining their competitive advantage over Lowe's and its peers, doing really well in the professional market, and doing really well, this is all coming from the BICO, by the way, and doing really well in with home improvement, actually starts to see some of those long-term trends benefit them, and that allows them to get better EBITDA margins. They also go further into the e-commerce business, lowering their cost, which further improves their margin. Now, again, we're talking about going back to where they were historically, but that's still an improvement in the margin, and notice that that would also improve their share price to about $2.90 a share. I also believe that what that practically means is that over here, this long-term growth rate could be as high as 6.5%. So instead of 6% G, I'm going to say 6.5% G. All right. And the idea is, back to that secular growth, inflation's under control, margins are improving, the market is continuing to grow a little bit faster than the economy for home improvement, as well as with building. And so that does allow them to grow their sales and profits at a little higher rate in the future. Now, with those 2 assumptions and that rationale, which I have written up as part of my paper, I then see that Home Depot share price is $322. Okay, that is my bull. So I'm saying, if all these things start to come true, in the next 12 months, Home Depot could trade as high as $322 a share. Now, by the way, if I kind of look and see where the analysts are, the average analyst actually thinks they're going to be at $341. So my bull is not even as bullish as where some of the analysts think their targets are going to be for the next 12 months. Okay, so maybe I will get a little bit more bullish on Home Depot in the bull scenario. What else might drive the bull a little higher? Well, one of the things that could drive the bull a little higher is that the margins a little bit higher. So maybe I'm actually underestimating how high the margins could be, and they might actually achieve 17.5% in perpetuity, and that gets me to a $335 share price. And again, maybe this growth rate actually hits 7% a year, so 6% a year, so 1 extra percentage point per year growth. Again, balancing a growth period versus eventual maturity, and that leads me to a share price of $384. Probably a little more aggressive than I want to be, so I'm going to call this 6.7. Okay, so I'm at $352. All right, so that's my bull. That's my rationale for my bull, and those are the assumptions I changed for my bull that lead to my bull share price. So again, the whole point of the bull is the optimistic scenario. Looking through a little bit more rose-colored glasses, what could go right, and if they went right, what are some of the things that could change, and if they changed, what could the share price be? So this is kind of what I'll consider the better case scenario for Home Depot in the next 12 months. Save this. Write that up, including your assumptions. Then go back to your as is. Now, from the as is, remember we're currently at 276, file, save as, the bear. Now I'm going to go in the other direction. What could go wrong in the next 12 months? All right, and what are the assumptions that could lead to the low end of the trading range for Home Depot? All right, how low could it go, and what would be behind that? Well, to some degree, it's partially the opposite of the bear, that mortgage rates stay high for a long period of time. The housing market stays very challenged for a long period of time. Growth becomes more tepid in the industry for both new starts as well as home improvement. And as a result, margins stay compressed because inflation remains stubbornly high for the next couple of years and takes longer to modify. So translation, I actually see a couple of things for Home Depot in my bear. Number one, that margins get worse. Okay. In 2021, they fell down to as low as 15.7%. What if margins in perpetuity went to 15.5% for the reasons that I just said, right? It's a tougher market. They see more inflation going through their supply chain channels. They don't see some of the growth in the out years. Matter of fact, in 2029, growth is zero. And we do see, leaving tax rate alone, we do see that e-commerce may not be as successful for Home Depot, and that a lot of growth is going to have to come from stores. So all of this growth of PP&E to sales, driving it down to 21%, maybe that goes back up to 25%. And they have to spend more on physical infrastructure as well as their stores if they want to continue to grow, worsening their productivity. And the other piece is the G. So instead of 6% growth into perpetuity, they only grow 5% into perpetuity. Okay. So summarizing, for reasons that I just said, G of 5%, PP&E to sales growing to 25%, EBITDA margin falling to 15.5%, and no growth in the out years. That basically means a share price of 201. Okay, that's my bear. Right. And so the idea is, for reasons that I've explained, I think Home Depot could trade on the low side at 201 a share in the next 12 months. And I think at the high side, if everything kind of goes in a more positive direction, Home Depot could trade as high as 352. Okay, so the final part of the analysis is the target. Where between 201 and 352 do I think that Home Depot is likely to end up? Now, it is your opinion, right? And the same thing is going to be true. We'll start out with the as is, file, save as, target. All right, so what is my opinion? And again, can't fault you on your opinion, so long as your opinion is somewhere between the bull and the bear and explains clearly why you're choosing to change the assumptions that you're changing. So here's the point. I actually do think that Home Depot has some upside. I do think that the housing market will rebound, as the analysts are talking about. I do think that mortgage rates will start to come down the next 12 months, and Home Depot will take advantage of a pent-up building boom and refinancing market and renovation market. And I think that home improvement is a great industry on a long-term basis. So I actually think their G is probably going to be even a little bit higher long-term at about 6.5%. I also think that Home Depot will maintain slightly better margins into perpetuity. So where the market had them falling to 16.4 from where they were at 17 to today. I think they'll actually get closer to 17 on a go forward basis. I don't think the tax rate will change. I don't think their productivity will change, but that actually puts my model share price closer to 322. And that is my target share price for Home Depot. I think in the next 12 months they could trade at 322 a share for reasons that I outlined, changing the values that I just outlined. Now, the final part of this is my buy, sell, hold opinion. Generally, the assumption is this: if you are trading within 10% of your current share price with your target share price, that is called a hold. All right, it's called a trading range. So I don't need to tell my funds that are paying me for my opinion that they need to do anything with their stocks because the company is probably fairly valued. If I think that my target share price is more than 10% above the current share price, then it's a buy. They should be accumulating more stocks because this company is undervalued. If I think my share price, my target share price, is 10% below the current share price, then that's a sell. Okay. Basically, the company is overvalued. We should either reduce or liquidate our portfolios. And that's where the buy, sell, hold opinions come from. Plus or minus 10% is a hold. More than 10% of the current share price is a buy. Less than 10% of the current share price is a sell. Okay. So in this case, 276 being their current share price, 10% of that gets me to a number which is below 322. So 322 is more than 10% above the current share price. I could even do a little math in here if I wanted to. So equals that times 1.1. So basically, if they're above 304 and I'm at 322, that should be a buy. So my buy, sell, hold opinion for Home Depot is a buy at 322 a share, 322.54, 323 a share. For the reasons that I gave you, that's your write-up. Okay. So starting with your next assignment, not this one. This assignment I just asked you for the as is of Home Depot, but starting with the next assignment, you're going to be doing 4 valuations: the as is, the bull, the bear, and the target. You are going to be explaining in a minimum 500-word paper for all 4 Excel models what your rationale is for each of those models' assumptions and why you're changing them across the models, and you're going to come up with a buy, sell, hold opinion based on that. Okay. Now, you're also going to be doing a group project coming up. You're going to be doing the same thing on a group project on a company that your team is going to select in an industry that I'm going to give you, and we'll probably do that next Monday. But regardless, this is what your homework 10 is going to look like for evaluation. So your next homework assignment, due 1 week from, you're watching this on October 30th, today, is going to be to turn in 4 Excel models: the as is, the bull, the bear, and the target. It's going to be turning in a minimum 500-word paper explaining the assumptions, so it's a Word document, and you're going to be turning in your screenshots: the DES, the WAC, the EEO, and if the tax rate is on it, the GUID. So that is kind of solving for Home Depot and setting you up to do your next valuations. But this is the reusable valuation model, so hopefully everybody was able to get to this point. And if you don't, please see your TAs for additional help. Okay, thanks for your time today, and that will conclude today's lesson.